Hello guys, so today I want to show you guys how I took a trade, NFP trade on NASDAQ. So essentially what I usually do is that I start on a daily time frame. Most of the time it goes to a weekly, but that's a topic for another day. If we go on a daily time frame, on ES it made all-time high on Friday, but NASDAQ did not make all-time high, so which means there was no sweep of liquidity above here. So initially this means that there's an SMT. This is where there's a there's a contradiction between pairs that are correlating, so which means that it's a sign that the market is going to reverse from its initial direction. So as usually we were waiting for a bullish continuation, but it turns out that there was no sweep of liquidity in NASDAQ. So this means that there is now SMT. This is a sign that the market wants to go back. So initially we want to turn back. So that's what I saw, and I wanted to take more trades. So I would go on 1 minute time frame. Now when I'm in a 1 minute time frame, this is what I want to see. I want to mark the highs and lows of the session so that I get liquidity, so I know what will happen during this time or what initially I want to be guided into doing. So if you look, this is the Asian session. Can you guys see? So this is the NASDAQ Asian session. Sweep the low of Asia, while on ES, look what happened. There was sweep of liquidity here. So this is Asian low. Look what happened, it has been swept. So this is a sweep of liquidity. Let's mark it red just so that we know. Asian low has been swept, but here Asian low has never been swept, right? So this is an SMT to also remember, but we are following the market structure, we're following the flow, right? This is a market flow, and we know the weekly profile is that there was no sweep of liquidity here, so which means there's an SMT happening. So now when news happen, and I would usually mark my 9:30, so that, because for me I usually start trading at 9:30, as you can see I've marked my 9:30 here, right? So when I mark 9:30 and my SMT there, now the immediate high and low I would mark them so that it can be place for me to target as form of liquidity. Now this is one, right? And you can see, because this is where news happens, so I would mark where the news happened on ES and NASDAQ, right? So there's also another, that's also my form. So let's say if the market swept here but it never swept this low, now I would essentially be looking for more continuation, but that never happened, because if you realize, this being my high, this was now my high. Now look at how NASDAQ played out. At 9:30, look at 9:30, there was a sweep of liquidity here. You can see the market swept liquidity on the high time frame. See, there's a sweep here. But at 9:30, there was also both sweeping. I don't know if you can see it on ES. You see how it swept, right? So here it invalidated my SMT, because they both essentially swept the highs, right? So now there's nothing for me to do. I'll wait to see which one will sweep liquidity. Now they swept again. Look at what happened. ES swept the high, right? You can see here ES swept the high, that the 9:30 high got swept, but on NASDAQ there was no sweep, so which means this is SMT. That's why I marked SMT right there, right? Now, and then the market plunged down, the market moved down rapidly. Now when it moved down rapidly, I'm looking for what? I'm looking for sales, so I would look for inverse. So now when the market swept this high, what do you think I'll do? This becomes my low. I would like to see this low being broken out of, right? And then I'll look for fair value gap to trade into. But look at NASDAQ, the same thing happened. Since we already know the sweep happened and the sweep did not happen here, I would mark the low that the sweep happened. So the low is here and the low is here. Now the market plunged down, dropped heavily, and then now this becomes my true state, my true change of state of delivery, if you can see. So the market broke this low, and you can see there's a fair value gap here. I usually mark the first fair value gap after the market has broken that low, and it broke, closed above, and then I waited for a retracement into it, and then I traded it down, marking my lows. If you can see from here, I have an indicator that mostly uses standard deviation. So if I don't have a target for me to reach, especially with liquidity, I would use this for this standard deviation. So as you can see, they usually fall. So there's 1, 2, 3, 4. So this was my target, and when I usually target here, I would look for the next immediate swing low, and you can see there was a sweep right here. When the market swept here, this was my low, So, and since it is near the standard deviation, I would initially target it. So that's why I had it marked. And yeah, the market played out, and now you can see it came onto it and then reversed into it. So I had two positions here, by the way, because for me usually I'll target two positions at most. I don't want to be in a position where I'm only using one and then I don't usually utilize or maximize on the opportunities that are there. Because if you look at it, my first trade was, I traded here, this was my fair value gap, I would place it there, and then my stop loss is usually above the immediate swing high. So that's my swing high, and with my initial target being the lowest, as I told you, the immediate here, this is my low. So if you look at this trade on its own, it's very valid, right? So on a normal day, how it's 1 to 6, right? 1 to 6.1. So this is 1 to 6. But now since I had another position added, why? Because the market gave me another opportunity. How? Because if you look at after it just entered and tapped into the fair value gap, it again broke. So which means my thesis has been supported by this candle. You can see this displacement is immediate, then there's a fair value gap up there, so I added another position there. So which means now I had two positions. Now when I usually add my position, my initial stop loss, I would move it at least half, right? So if I'm planning to lose $100, now I'd initially lose maybe $70, $60, right? So that's how it usually is. So my next position was here, and when I placed the position, I moved my stop loss was placed at where I initially entered my first position, right? So it was, yeah, it was at the immediate high. So as you can see now, if I'm to place this below here again, guess what happened? This is 1 to 8, and I already had 1 to 6 here, so 8 plus 6, right? So you can see that gives me around approximately 14R. So which means, let's say for $1 I was to get $6, now I get, for every $1 I get how much? I get $14. And here initially I was risking $50, here here I was risking $100, here I risked $50, so 150, you do the math times the RR, and that's how the market played out, and that's how I made the trade. If you want to learn more about this, contact me, link in the bio, and you'll get to see more. Thank you.